James, here we are at the start of a new year. How then did the managed solutions portfolios fare in January?
January was a good month for the managed solutions from a relative perspective, most importantly, outperforming their benchmark. Global Cautious beating its benchmark by only 10 basis points net of all fees, but it's still a positive outperformance. Global Managed 40 basis points and Global Growth 70 basis points net of all fees.
It's a pleasing outcome, James. Looking behind the numbers, what were the key asset allocation decisions that led to that performance?
Yeah, interesting dynamics in the market over the month. You had a number of positive local currency returns for the major markets, but translating them into US dollars, which was again strong, weighed on returns, coupled to the fact that the US was actually negative over the month in US dollar terms, led to negative returns from global equities. So the portfolios aren't immune from that, of course, but luckily the positions we have in place did mitigate that somewhat. And for example, we have an underweight in the US, which was the worst performing market, so I'm pleased to say we're underweight the US over the month. Overweight Europe. Europe was up nearly 8% in local currency terms, but again, once you translate that, almost all of that gain disappears thanks to the strength of the US dollar. Nevertheless, in dollar terms, Europe's still flat to maybe slightly up, which is definitely better than we would have got in the US, so having that position there helped. Emerging market equity, again, a relatively meagre gain over the month, but again, better than the US, and helped drive some positive alpha there. Within the fixed income part of the fund, a positive month for global government bonds, clearly given the backdrop of European sovereign QE, it really sort of gave another positive push up to the fixed income markets. We're underweight sovereign bonds in this portfolio. We do think they're very expensive and we don't want to have too much in there, but we do mitigate that by having positions in a variety of credit securities in the fixed income markets, and that actually helped our returns as well.
You've touched on some themes there, James, but a general note on where the portfolios are positioned as of today.
Yeah, so we've got a broad-based global allocation to the equity market in these funds. We are underweight the US, we're overweight Europe, and overweight emerging markets today. We think there's good valuation to be had in those two markets. There's a lot of bad news priced in. We also use a number of specialist niche strategies in the portfolio to give us a particular profile in the equity portion of the fund. For example, we use Copernic's Global Contrarian strategy, and we make use of First State's Global Listed Infrastructure securities to give the portfolio a very particular profile that we want. Within the fixed income markets, we're heavily underweight sovereign debt. We do think it's fundamentally very expensive, and we'd rather be taking positions in a large and diversified range of credit strategies to offset that heavy underweight. In the other final part of the portfolios, we've got an overweight in cash. It's not a big position today, but it is still a significant holding, if you like, and it's one that we think, while it's not great in the short term in terms of it doesn't generate any income for the portfolio, it does give us a store of value if and when government bonds sell off, and it gives us some dry powder to put into the markets when we see volatility and with the volatility, enhanced valuation opportunities.
Thanks, James. Finally then, just a comment on your outlook.
Yeah, I think looking around the world today, we're still broadly constructive. Our view hasn't really changed much over the last few months. We're in a world where oil has dropped substantially, great for the consumer, great for most businesses, in fact, unless you're an oil major, and great for most economies. It's almost a tax cut. It makes life a lot easier for central banks, for example, who were worried about inflation up until a few months ago. Coupled to that, a world where central banks are remaining very loose in their monetary policy. ECB's just turned up with extra QE. So I think it's reasonably easy to make a constructive view on the equity market, despite the fact they're probably through fair value today, but they're nowhere expensive. So we're broadly constructive on the equity market. We're leaning towards that in our portfolios, but we're not putting all our eggs in one basket. We're not getting overexcited about it. We're staying diversified, staying risk aware, and keeping a nice broad base of return drivers in the portfolio.
Thank you very much, James.
Thanks, Richard.